Good day, everyone. You're welcome to this week's Business and Investment Tips program, a production of the RCCG Christ Church Radio with Ayodeji Ebo, an investment professional. This week, the focus is on the implications of the CBN's interest rate hike. The Central Bank of Nigeria's CBN highest policy-making committee, the Monetary Policy Committee (MPC), held its first policy meeting on the 26th and 27th of February 2024 under the chairmanship of Dr. Olayemi Kadoso, with all 12 members present. Remarkably, all the committee members voted for a 4% or 400 basis point increase in the monetary policy rate (MPR) to 22.75%, the highest level since its introduction in 2006. In addition, the asymmetric corridors around the MPR were adjusted to 100 basis point minus 700 basis point from 100 basis points minus 300 basis points. Moreover, the cash reserve ratio (CRR) was increased by 12.5% to 45%, while the liquidity ratio was retained at 30%. The MPR is the interest rate at which the CBN lends to commercial banks. The MPR is the benchmark against which other rates in the economy are pegged. It is also used as an instrument to control inflation in the economy. Though the MPR has been ineffective in recent years due to the more prominent use of OMO securities, the rate has recently regained influence in signaling CBN's intentions. The asymmetric corridors are used to determine the following: the Standing Deposit Facility (SDF) rate. This is the lower band, minus 700 basis points or 7% around the MPR, and the rate at which banks place funds with the CBN, 15.75%. The Standing Lending Facility rate, 23.75%, depends on the upper band. 100 basis points or 1% is the rate at which the banks borrow from the CBN. The cash reserve ratio is the minimum amount banks are expected to retain with the CBN from consumer deposits. This implies that out of every 1,000 naira deposits collected by the banks, 450 naira is expected to be with the CBN. Effectively, the banks can only transact business and earn income with only 550 naira out of the 1,000 naira. Liquidity ratio is the ratio of a bank's liquid assets, cash and government securities, to its liabilities, mainly deposits, which remain at 30%. This is to ensure that the banks are able to meet with their short-term obligations, that is, the ability to pay back your money anytime you request. Now, what are the implications of the rate hike? 1. Rise in interest rates on savings accounts. The minimum rate on savings accounts is fixed at 30% of MPR in Nigeria. So when MPR increases, the savings account rate increases. Higher interest rates can encourage people to save more, as they can earn a higher return on their savings, given that the minimum savings rate has increased to 6.8% from 5.6%. However, this is subject to other conditions which vary across banks, like limits on the number of withdrawals per month to qualify for interest. Increased savings can also be beneficial to the economy in the long run, as it can increase the amount of money available for investment, which can help boost economic growth. 2. Higher rates in fixed income securities. The interest rate on fixed income securities, especially Nigerian Treasury bills, has improved significantly in the last few weeks ahead of the hike in MPR. The MPR hike further buttresses the CBN's position to entice investors to fixed income markets, which may reduce speculations on the exchange rate, depreciated by over 50% year to date, as well as compensate investors for the high inflation rate, 29.9% in January 2024. At the most recent Treasury bills primary market auction, average stop rates closed at 17.8% from an average of 6.8% on the 10th of January 2024 auction. 3. Higher borrowing costs. Following the hike in the MPR to 22.75% and the asymmetric corridor of 100 basis points, borrowing costs is expected to increase. Maximum and prime lending rates closed at 27.1% and 13.8% respectively in January 2024. The increase in MPR will result in an increase in the cost of borrowing for businesses and individuals, particularly loans that are floating or variable rates based. However, the impact of higher interest rates goes beyond just the cost of the borrowing. The risk of loan defaults and impairments also rises by borrowers struggling to keep up with the increased payments. This, in turn, could dampen the profitability of banks and other lenders. This may, however, be offset by increased interest income on loans. 4. Foreign investments may remain muted. Despite the potential benefits of higher interest rates in attracting foreign investors seeking better returns, Nigeria's current economic conditions have deterred such investments. The country's volatile and illiquid FX market has made it less appealing to foreign investors. Consequently, foreign investments will likely remain limited until policymakers take bold steps to address these concerns. 5. Negative impact on stocks. The MPR hike will negatively affect equities, especially non-financial stocks, given that yields in the fixed income space are now significantly attractive. Higher borrowing costs will negatively impact non-financial companies' profitability. However, banks will benefit more in form of higher interest income from fixed income securities and loans. The equities market may become unattractive from a dividend yield perspective and poor financial performance on the balance of factors. The continued entry of new investors, domestic, may reduce the impact as well as stronger than expected financial scorecards. However, this presents opportunities for long-term investors. The MPC meeting holds bi-monthly, with the next one coming up on the 25th and 26th March 2024, where we believe the MPC may retain the interest rate given the need to study the impact of the recent hike on the economy. Thank you for listening. Please join us same time next week for another exciting and insightful session. For questions, comments, and feedback, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 070-8246-3747. Stay blessed.